Welcome. It's good to talk to you. Appreciate the guidance. Certainly, we have seen a lot of pushes to January, and in the case of others like Microsoft, not even putting a date on a full return. How much momentum do you think that's taken away?
Quite a bit, actually. There was a lot of enthusiasm for the return to office that is now delayed, as you said, Carl. But more important than that, people are trying to figure out what happens even beyond the next 6 months or so when the Delta variant hopefully works its way through the system and we come out of it with some kind of a solution, which is expected to happen anyway. We're going to have these speed bumps after a global pandemic. And around that topic or discussion, we are for sure hearing from our clients, major office owners all over the country, that they are expecting less office demand in the short term. But as the economy comes back and you have new business formations, which, as you might know, last year was at a record and continues to be at record levels, we're going to see new companies form. We're going to see new expansion of space demands. And therefore, there should be an offset behind the current delay.
Wait, I'm looking at this list here of cities with the strongest office demand and those with the weakest. So on the strongest, it's Boston, it's Austin, Nashville, names that make sense. Weakest, New York City, sadly, number one, D.C., Chicago. What do you think makes the difference between what list you end up on? The difference between Boston and New York, you would think the differences might be negligible.
You're right. It has to do with the size of the central business district. It has to do with the amount of public transportation that really drives the amount of workers that come into a central business location. And of course, the nature of the office using jobs. The differences aren't that much. It's not like those markets are on fire and New York is completely lagging. We've seen a lot of improvement in New York. We've seen a lot of improvement in other lagging markets like D.C. or Chicago. It's just that they had a bigger problem to solve, if you will, because the pandemic had a larger impact on a bigger market.
The idea that down the road this is creating more demand because of new business formation and people anticipating some kind of a return to normal, how does the big companies rethinking their overall space footprint play into that? I mean, the idea perhaps that they'll have fewer people in the office, in some cases longer term, maybe playing against the fact that they want more space per person.
You know, what we're hearing mostly from our clients is that there's going to be a need for plenty of time in office for collaboration and team interaction. Everybody wants that, whether it's the employees or the employers. And there's no doubt that there's going to be a high degree of pent-up demand for that in-person collaboration. So the space configuration to accommodate that for team space, for meeting space, for collaboration space is really overshadowing the need for typical offices, individual offices, and cubicles. So that the use of space is starting to get reshaped, as well as the fact that if you have this hybrid notion as a lasting strategy where people are in the office, let's say 3 days a week, but can work virtually, remotely a couple days a week, that spells a return closer in to central cities where during the pandemic we saw people flee and go to suburban markets or even tertiary locations because everything was completely virtual. If you're having to come in the office 2 or 3 days a week, you still need to be fairly close. So from a housing perspective, that also plays into the fact that urban market housing had become very expensive. And now those rents have adjusted, and especially the younger workers are now getting more attracted to coming back closer into the urban markets. So you have a lot of fighting dynamics. Meanwhile, as an investment, commercial real estate is one of the most attractive investments this year. We've seen so much capital flow in. With the exception of office space, buyers are still very reluctant until they see more evidence of all these dynamics play out.
Although the Journal this week did a piece on PIMCO, for example, ramping up its commercial real estate holdings as they're trying to make up for low returns on corporate bonds and so forth. Are you being aggressive, would you say? And is the industry overall looking to be aggressive given opportunities that may come up?
We are as an industry, and the reason for that, Carl, is because you have a lasting economic recovery with some speed bumps, granted, with the Delta variant and all that, but there's almost $5 trillion of excess capital that has been created as pent-up demand that's eventually going to get released into this economy. You have incredibly low interest rates. So even buyers of office space, they're not out of the market. They're in the market taking advantage of low interest rates way ahead of the recovery, and every other property type, whether it's apartments, that's really viewed as a safety investment because they've performed so well, or shopping centers that are viewed as a turnaround and reuse strategy, which is very popular right now with so many of our clients, are seeing record amount of trading. So the investment market is looking beyond this current cloud, if you will.
Shepard Smith here. Thanks for watching CNBC on YouTube.